Well, joining me now is former economic advisor to President Reagan and Laffer Associates Chairman Art Laffer. Art, it's great to see you. Okay, so we're at the point, Art, where we're talking about chicken or turkey for Thanksgiving. That seems like a bad place to be. But Art, talk about what this means for spending. I think the real concern here is consumers might be getting to the end of the line. How concerned are you about a drop in spending over this holiday season?
Well, I'm not superly concerned over it, Brian, but what you've seen happen is wages have not risen as much as prices. So real incomes have dropped, which means that people will have to cut back on their spending. We haven't had any surge in employment in the country. If you look at the participation rate, it's not gone up. So you don't have any huge new people joining the income stream. So that's not going to happen. What has happened, however, is the rate of inflation has diminished dramatically, but not for very long, and those numbers still are very bad. But as far as being as bad as they were, they're not. They're much better than they used to be, but they're still bad, and prices are still a lot higher than they were a year ago. And that means that people are going to have to accommodate lower spending. They're just going to have to do it.
But Art, you know, you think about the average American household. They've got the inflation issue. We can see the prices of turkey and all these things around a holiday, you know, which is kind of a downer around a holiday to have to pay so much more. But the real issue with American households has been the run-up of debt. American household debt is at record levels. Credit card balances rising at 15% year over year. I mean, that's more than 15%. That's the fastest in 2 decades, Art. How big of an issue is it that American households are taking on so much debt at this moment when prices remain so unaffordable?
Well, I think it's really even more dangerous about what the economy is going to look like into the future, Brian, because if they take on all this debt now, they're going to have to pay it back later, or they're going to have to suffer the interest expenses. Not only are they taking on higher debt, which they are, but the interest payments on that debt is much higher than it will be. I mean, much higher than it has been. And that means it'll be a much bigger problem for the budgets of families going forward. And that's a serious long-term problem. That debt increase cannot continue the way it has without a big increase in bankruptcies future. And that really bodes very badly for the U.S. economy.
And yet it seems to grow apace as inflation still remains high, maybe not at its heights. But I want to talk with you about this railway strike, because this, to me, has been a big X factor in the background. We got what looked like a little resolution in September. That looks to me more and more like a political move, not an economic move. Now we're seeing that we could have a strike. I mean, Art, when you think about how many goods are moved on rail cars every single day, 300,000 barrels of crude every day, what kind of effect would that have if we even get a short railway strike in early December?
That would have a really substantial effect. You're way too young, Brian, to remember the days when we had nationwide strikes, auto strikes, coal strikes, Ruther, all of these people. I mean, the strikes. Going back to that type of era where unions try to get wage increases by always threatening and then doing strikes, nationwide strikes, is not a nation you want to be in. It really is very disruptive to the economy. And then we hit that calm period when Reagan was elected, and it never really came back to the old time strikes. But it looks to me right now that the issue of union militarism and all of that is coming back, and you're going to see a lot more strikes, a lot more pressure by unions to, in fact, raise wages. If not, then strikes. That's not a good world to be in. Just for the facts, those states that have right to work are growing much faster than the states that don't have right to work. That means that the union pressure is a very detrimental effect on the overall economy. And I'm worried about a rail strike and anything else that would follow it.
But, you know, the President Biden has basically offered unions the keys to the kingdom here. Every single economic speech he gives essentially says, I want union jobs, I want union influence in states that have right to work. Art, he's setting the table for these kind of strikes, is he not? I mean, if you're a union worker, yes, you know you're in the driver's seat. So maybe it starts with railway, but how much deeper could this go, Art, if the president's setting this kind of tone?
Well, if you go back in time, it can go very, very far. I mean, in quarters. Now, I did an econometric model in 1972, and I had to take into account union activity to be able to explain GDP growth, Brian. That's how powerful an effect it was from quarter to quarter changes in real GDP. We've had nothing like that since the late 70s. We really haven't. If we go back to that era, you're going to see a lot of damage done to the economy because of union strikes and work stoppages and all of that. And that's not a world you want to go back to. It's really, I wish the whole country were right to work, but Biden wants to take time back and look at everyone as a forced union state. That's not the way the U.S. should be, and that will really hurt the economy in the long run.
Art, what worries me is you have the Federal Reserve raising interest rates very quickly, obviously trying to crush demand, and I think you're starting to see real signs of that, in fact. That might get you part of the way on the inflation story, but you and I both know that the inflation story is also partly a story of supply chains, of a productive America. So I look at getting out of this inflation mess. Yes, I'm happy that it's come down a little bit, but at what level, Art, do we get stuck where the Fed's done all the damage it can do? It's got inflation down, but unless we get more productive, prices are going to remain high.
Well, don't for the moment think that inflation is down low enough to where it's acceptable. It's not, Brian. It's not way up at the heights it was, but it has dropped down to where it's a lot lower today than it had been, let's say, 4, 5, 6, 7 months ago. But it's by no means to an acceptable level, the inflation there. Now, what should the Fed do? I have always been opposed to what the Fed has done by raising interest rates a little bit at a time. Paul Volcker, when he brought it under control quickly, he let markets set interest rates. Then he followed with the discount rate following the market, not leading the market. This Fed has decided that price controls are the right answer for interest rates, and therefore have put the Fed's balance sheet between interest rates where they should be and interest rates where they are. And that Fed balance sheet has expanded to being almost $9 trillion. And that's what needs to be contracted to bring inflation down. And there's very little contraction going on now. There has been a very slight reduction in the Fed's balance sheet, which is good news, but it's not nearly enough to bring that inflation down for any long period of time. Now, on the other side, on the good side, it's too much money, now chasing too few goods. There are no policies being put into by this administration, whether it be the union stuff, whether it be the regulations, whether it be the government spending. There is nothing in this administration's policies that would increase the supply of goods.
Right.
What you want to do is have reduced money and increased supply of goods to bring inflation down in the market sense, and thereby be willing to accept a 0 or a 2% inflation per year. We are not anywhere near that in this economy at present.
That's the point. We are nowhere near it because we have no effective supply side policy from the Biden administration. Never have, and I'm afraid we never will, at least for the next 2 years. Art, we got to leave it there. Always good to see you. Enjoy that turkey on Thanksgiving, sir.
I will. I'm having chicken just so I'm man of the people, Brian. No,
a man of the people, Art Laffer, of course.
Thank you very much.
All right, we'll see you, sir.
My pleasure.